So we got some spooky, scary trading risk. And I wanted to talk about this because we've talked a little bit about like how we've defined the risk of certain options in the past, primarily from using the Greeks. But today I wanted to talk about maybe looking at historical risk factors based on historical performance, which you always have to take with a grain of salt. But I thought it'd be interesting to look at this just because there's a pretty significant difference in how you would look at the historical risk of a stock versus the historical risk of an option. And today I kind of wanted to talk about why. Make sense?
Yes.
Awesome. All right, let's get in here. Okay, so just for a recap on some of the stuff that we've already talked about, we've already covered some pretty important Greeks. In my opinion, the three most important ones, which were delta, gamma, and theta. So we talked about that in a previous segment. But those give the expected change in the options price given a change in some other variable, right? These Greeks are based on the outputs of the Black-Scholes model, which is based in market theory and market assumptions, right? It also gives the expected change. So it doesn't give you a good look into the historical window of a stock or an option or whatever you're looking at. This would be primarily for options. So today I wanted to look at the risk factors that we can quantify based on purely historical performance, which even though you have to take those with a grain of salt, there's some utility in doing that because like I said, the Greeks are based on a financial model. They're based on certain assumptions and simplifications around the market. So there is some utility to looking at the historical performance, which can sometimes deviate pretty significantly from our theoretical expectations. Make sense?
Yes.
Cool. Okay, stock distributions, everybody. So to quantify the risk of a stock, investors will typically look at the returns distribution of the stock and its different moments or variations of those moments. So we usually don't talk, at least like outside of math class, we don't usually talk about the moments of a distribution, but you'll know at least a couple of these when we start to talk about them. When we look at the return distribution, just as like a point of note, of a stock, we usually look at it relative to the normal distribution because this was like the foundational distribution in the Black-Scholes model, which is not necessarily a correct assumption, but it's still an assumption that is pretty key in financial research and financial modeling and data analytics and all that kind of stuff. So when we look at the returns of a stock or an option or whatever, we normally look at it relative to the normal distribution. And it has some pretty key characteristics that don't necessarily represent how a stock normally moves, but it's still a simplification that makes the math behind the models a lot easier. Make sense?
Yes, makes sense.
Cool. So moment one, probably pretty familiar with it. Again, when we're looking at the returns distribution of a stock, that's the expected value or the mean of, it usually also means the mean of the distribution. And that basically gives you the central tendency of a distribution. So when you're looking at the first moment or the expected value or the mean, right, of a stock returns distribution, it says, what on average does this return on a daily basis, for example, if you're looking at like daily returns, right?
Yeah.
Make sense?
Yes.
So first moment, expected value gives you the mean, gives you the central tendency of the distribution. The second moment is the variance. So this is the spread of the distribution. And then the square root of the variance is also called the volatility or the standard deviation of the distribution. So this gives us a pretty good estimation, at least historically, on how much variability there's been between of the value or of the returns of a stock. So the bigger the volatility, the more uncertainty there is around that measurement. Right, which means we can have less certainty around like the average return of that particular underlying. Make sense?
Makes sense.
There's more volatility, there's more uncertainty. Yep. And then for context, again, because we're comparing stock price movements to the normal distribution, for the normal distribution, about 68% of the occurrences are within the one standard deviation mark. So that's not always going to be true for every stock, but when we make this normal distribution assumption, or when we apply the normal distribution to stock returns, then this is what we're comparing it against as a point of reference. Make sense?
Yep.
Easy peasy. The third moment, which people don't talk about as much when it comes to stocks, but it's going to come up a lot with options, is skewness. So that's the third moment. So that's the asymmetry of a distribution. And we can see here that this is a very symmetric, right? It has no skew in this distribution. This is perfectly symmetric, but we're not always going to be dealing with with symmetric distributions. We might be dealing with skewed distributions. And in the case with options, they happen to be heavily skewed when you look at the P&L distributions of that particular strategy. So that's why this metric is going to become a lot more relevant, but maybe not as relevant when we're looking at stocks, even though it's still helpful to look at. It's going to be way more relevant when we're talking about options. And the fourth moment, which people don't talk about, but is still helpful to talk about, is kurtosis. So this gives you the heaviness of the tails of a distribution. So what we can see here is that the tails fall off pretty much immediately, which means those really extreme moves to the upside or downside are not very common. But in certain types of distributions, we might have very heavy tails, which means those really big outlier moves might be more or less likely depending on the underlying. So like there might be heavier tails with like an Amazon returns distribution compared to a SPY return distribution, because Amazon tends to be a lot more volatile and can maybe have much bigger moves around like earnings, for example. Make sense?
Makes sense.
So these are different moments. This is normally like, the different ways that we'll quantify stock risk and skewness of the And these moments, specifically variance, it tends to be more the most used. But these moments are ultimately used in a lot of the risk calculations that we'll have around a stock. So whether we're talking about volatility or beta, which we've talked about before, or something like the Sharpe ratio, a lot of these different moments of the distribution are ultimately going to be used in these calculations in one form or another. So volatility, for instance, that we talk about it all the time. It measures how variable a stock's price has been, and it's the square root of the variance. So here we're using that variance moment of the distribution, and we're modifying it to basically look at like how much variability is there in the average return of a stock, right?
Yep.
Makes sense? And then beta, which we've also talked about, beta weighted delta. But when we look at the beta of a stock, which is a little bit different than the beta weighted delta of a stock, or of an option rather, that measures the stock's volatility relative to the overall market. So here we're going to be basically pinning it or pegging it to some kind of reference index, like SPY, for example, or the S&P is one that people will normally look at. Like, is this more or less volatile than the overall market? And that is calculated as the stock's covariance with the market divided by the stock's variance. So here again, we're looking at something divided by the stock's variance. So something that is like a modified version of one of those distribution moments. Make sense?
Makes sense.
And then the Sharpe ratio, which is a super common risk-adjusted reward, basically, is the expected value of the stock's excess return divided by the stock's variance. So again, we're looking at a variation of one of these distribution moments to calculate different aspects of the stock, historically at least. And there's a bunch of different ways that you can calculate the risk of a stock, but like a lot of the time it incorporates in one way or another these distribution moments in some form. Make sense?
Yes, definitely Sharpe ratio, one of the most common ones. I've seen it a lot talking to the Jack D. Schwager books. That's market wizards, unknown market wizards, hedge fund wizards. He actually decides which investors to interview depending on their Sharpe ratio. So that's where I learned it, and definitely it's very interesting. I think, I don't know, well, maybe in the States, but here, many traders that I've talked to or investors don't know their Sharpe ratio. Neither do I, but it's one of the things I've actually wanting to do, maybe to take all the data from my trades and get a Sharpe ratio, which is a risk reward, because you can get your Sharpe ratio from your portfolio.
For sure, yeah. I've used Sharpe ratios a lot. I find it to be an incredibly useful metric, but we're going to talk about why this is true in a minute. But they all of these metrics actually, historical volatility, beta, Sharpe ratio, these break down when you apply them to options. And we'll talk about why in a minute. But Sharpe ratio, when it comes to like stocks, or looking at the historical performance of a stock portfolio or something like that, I think that gives a really good representation of risk-adjusted return. Obviously, it's not a complete picture, but Sharpe ratio is one that I definitely use a lot. Make sense so far?
Yes.
Cool. So let's get messy. Option P&L distribution. So option P&L distributions are heavily skewed, and we're going to look at an example of that in a minute. But short option P&L distributions have negative skew. And distributions with negative skew have the majority of occurrences on the positive side of the mean, with a really large negative tail on the negative side of the mean, right? And in this situation, when you have these heavily skewed distributions, our expectations around moments and around these historical statistics that we use for stocks, they have to change. And we'll talk about why in a minute. But does that make sense so far?
Yes, makes sense.
Cool. So when I look at a skewed distribution, and this is actually from the book, but when I look at a skewed distribution, I immediately can see that this does not look like the nice curvy normal distribution that I was seeing before, right? It doesn't even look like a stock distribution. But what I can see here, especially in that second picture and the one labeled C, is that most of my occurrences are on the positive side. Here I'm just looking at a short 16 delta strangle from 2005 to 2021. 81% of the occurrences are positive, which means that strategy made money 81% of the time. But what I can especially see in that first picture is that there's a really big negative tail to the downside. So while the upper side of my distribution doesn't go past 2,000, for example, in terms of my P&L for a strategy, the downside can go to negative 8,000 in the worst case scenario. So we can see that even though I have this positive concentration or concentration on the positive side, it could pretty much, really big negative tail to the downside. Make sense?
Yes, definitely interesting.
It's super interesting. And to be, just as a caveat, the mean of the strategy is not 0. I was just looking at positive and negative. So it's not going to be exactly 81%, but that's kind of an aside. You can still see the characteristics of the skewed distribution in this case. Make sense?
Makes sense.
Which is pretty consistent with our risk reward expectations around short options. Like short options are like owning the slot machine, right? You make small profits most of the time, but there's a chance you might have to pay a jackpot, right? With a strangle, because it's undefined risk, that jackpot could potentially be very large. So, right, they don't happen a lot, but they can break a portfolio for sure if you're not prepared for them. Droughts don't happen a lot, but if you are not prepared for them, and if you don't size your positions, it can be no bueno. For sure. And then another, so again, right, remember when we were looking at those moments, those distribution moments of the stock distribution, and we were saying that for a normal distribution, right, 68% of the occurrences, for a normal distribution, 68% of the occurrences fall within the 1 standard deviation range around the mean. And when we're looking at this strategy, so when we have that solid black line that shows the mean of the strategy, and we look at the 1 standard deviation range, way more than 68%. So again, we can see how our real life data is differing from these assumptions that we're making. Actually, let me rephrase. We can see how when we try to apply these normal distribution assumptions around options data, that starts to break down. Because while the standard deviation gives you some great information around maybe the range in which most of the profits and losses are going to be, it's not the nice symmetrical case that we saw in the normal distribution, which is something that stocks resemble much more closely, even though it's not 100%. Make sense?
Makes sense.
Cool. So, and we can just see again where the skew is coming in, where we have 77% of the occurrences on the positive side of that mean and 81% positive overall. And that's where our 81% historical pop for the strategy comes from. See? Yeah.
That's why it's way better being on the short side of the premium.
Yeah. But again, right, looking at this case, I definitely prefer to be on the short side because I like that 81. I like that reliable profit. I like having consistent profits. I like having frequent profits, and it's a lot higher than the 50 or 55% that you might see in a stock. But that's why almost all of my focus is around controlling for those $8,000 losses, those really unlikely but potentially very large losses. Because in my mind, right, is that if you're owning the slot machine, then you just have to be in the game as long as possible to most likely make money. So it's more of an endurance thing, and those really big losses can be really, really detrimental.
Just like the casinos, they prefer to have clients that are going often, losing constant money. Applies the same over here, being the casino selling premium small, rather than the casinos hate those big players that may come for the first, second time and just being big and never come back again.
Yeah, that's those are the worst customers for a casino. That's how you make money at the casino. It's you win money and then walk away and never come back, because eventually the statistics will take you down, right? But it's the same. So in my situation, when I'm selling premium, those tail occurrences, even though they're really unlikely, they do not happen a lot, are my primary concern, because even though they don't happen a lot, they will ultimately impact endurance or your ability to stay in the game.
That's what personally sometimes I doubt on maybe selling some premium, because it's expensive, just naked.
For sure.
And you can maybe it's not common about those occurrences, and you got to be prepared, and you might take a big hit. That's why your strategy is going wide with a definite risk. It's way better.
For sure. But again, it's for me, it's like not an inefficiency in the market. It's a trade-off in risk. Like you get that 81% profit, but that's not for free, right? Or 81% probability of profit. That's not for free. There's risk somewhere else. So you have to make sure that you understand your risk profile pretty significantly. But again, talking about standard deviations, mine are different. So just to kind of summarize, for option P&L distributions, we can still gain meaningful information from looking at that volatility. So looking at the volatility of the historical P&L distribution, it can still give us some information about like maybe the range where most of our profits and losses have fallen historically. But because we have this heavily skewed distribution, this looking at like historical volatility basically of that distribution has to be supplemented with some more comprehensive metrics for tail risk, right?
Right.
So ones that I use maybe the most, there's a bunch of different metrics, but we've talked about this before, is conditional value at risk, which is based on value at risk. So value at risk estimates the potential losses of a portfolio or a position over a given period of time at a given likelihood level. So for example, over any 1 day period, one can expect to lose at least $1,000 at most 5% of the time. At least $1,000 at most 5% of the time. So again, there's a bunch of different ways that you can quantify tail risk. You can look at like worst case loss. You can look at value at risk. You can look at conditional value at risk, which is personally what I prefer. But you need some better way to quantify the tail risks because of that heavy skew in the P&L distribution.
And then, the bar is the 95% confidence interval, no? That's why you have the 5%.
Exactly. Exactly. And you can tweak this. You can look at like 10% of the time. You can look at a bunch of different stuff. But again, because that tail for option P&Ls can be so big, I tend to look at something that's a little bit more extreme to be a little bit more conservative from a risk perspective. Make sense?
Makes sense.
Makes sense. And then conditional value at risk is a variation of value at risk, but this gives the estimate of the expected loss of a portfolio or a position if that worst case loss threshold, the value at risk, is ever crossed. So basically what we're doing is we're looking at the value at risk to the bottom 5 percentile of the distribution, and we're taking a weighted average of those occurrences, and that's going to give us conditional value at risk. So it gives an even more extreme estimation of that tail risk than even value at risk. And I didn't want to like badger people with a ton of math, so we're going to talk about value at risk and conditional value at risk in the next segment. So like in the next episode, basically on Thursday.
That's good.
But hopefully this gave like a good summary, I guess, of like why we have to like fundamentally change our understanding of risk when we're looking at stocks compared to when we're looking at options, especially when we're looking at from a historical perspective, right? Because the characteristics of historical stock behavior and historical options behavior are drastically different. So you have to really understand the shortcomings of the metrics that you would traditionally use, right, when you're analyzing stocks. So like the Sharpe ratio, for example, you can apply it to options, but there's a bunch of risk that's not accounting for. So we have totally new metrics. Those include like the Greeks. And then when we're looking historically, those include like value at risk, conditional value at risk, skew. There's a bunch of different stuff that you could look at. It's going to be like strategies are going to have like different characteristics, but the fundamental, like the market theory behind option risk and return is that like you're taking, in exchange for getting consistent profits, you're taking on tail risk. That's not likely to happen, but it can be potentially very large. So and then on the long side, that situation is flipped. So you could potentially have very, very, very large upside with a low probability, but you're most likely going to take losses. So it's really flipped. And again, very fundamentally different from what you would see with stocks. So I think that's all I got. And next episode, we'll take a look at VaR and CVaR in a little bit more detail, and looking at using like Monte Carlos to calculate conditional value at risk right now, where you don't necessarily need historical data. So that should be hopefully pretty cool. Hopefully that was entertaining. Now, maybe not entertaining, but educational. It's like taking your medicine.